Hey everyone, welcome back. This is part two of the GameStop update. If you didn't watch part one and you're interested in just learning a little bit more about the company and some of the opportunities and risks, the slide that's up right now is what we talk through there and just kind of some of the things that are changing at GameStop as a company. But now we're going to hop over. The next slide we have here is this is just a summary of their most recent earnings release. So, you know, high level. Um, we'll kind of walk through it, right? 6.5% increase in comparable store sales during the fourth quarter, and their global e-commerce sales increased 175% for the fourth quarter and 191% for the full year. So, I mean, these numbers sound good, um, but something to keep a note here for same-store sales, they've excluded stores that were closed for more than 14 consecutive days or didn't have curbside delivery available. So honestly, my guess is this is most of their stores are excluded from the statistic. So right, if there's a store that was closed for a month during the pandemic, they are excluding it from same store sales, which I mean, yes, it makes sense, right? Like it was closed, but does, um, is this skewing the statistic to only stores that were able to stay open and did relatively well? And that's good that they stayed open and they still did 6.5% growth. But I think there's probably a lot of stores that were only closed for, a couple of weeks, barely over that 14-day period or something, and just performed awfully, but they're excluded from the stat. So it would be good to have store level detail, but you're probably never going to get that. Next thing to note is expense reduction. So 409 million in SG&A savings in fiscal year 2020 compared to 19. This is, I think this is a BS stat. We'll look at it when we go look at their model. Their SG&A as a percentage of revenue is the same. If your revenue is declining, you don't need as many people to support the operation. You're not saving money here. I don't know. I don't buy it. They did strengthen their balance sheet. It looks healthy. They got a good amount of cash. I think they have like 300 million of debt. 120 million of that is short term. So I think from a cash perspective, they're probably in a pretty good spot. And then exciting, they also announced a new COO, Jenna Owens, who's was pretty successful at Amazon in their fulfillment practice. It looks like so she could actually be a great addition as they move into this e-commerce. Fourth quarter alone, they were down 2.1 billion versus 2.2 billion. Um, and the 12% decrease in store base, but they closed the stores that weren't performing. So if anything, it's really not like those stores were driving a lot of sales. Their digital sales are up 175%, and you have the launch of the new consoles. COVID's over, stores are open. Right? Everyone was saying with this console refresh, sales are going to blow it out of the water. It's going to go back to GameStop at 2010. No, it's not. Not even close. Even with these new console launches, like that's not enough to save this company at the scale it's trying to operate at, right? Like without the sell of video games and trade-ins and all that, like there's not as big of a market for them. So I think it's just something we have to get used to is them being a smaller company going forward. Gross margins declined, so 6.1% or 610 basis points. They said it's a shift in a mix to lower margin products. So before you probably have good margins on video games, things of that nature, and especially the used game market, right? Like those margins are probably great back in the day. But they're saying the consoles have lower margins, and then the associated credit card and e-commerce sales. For their online sales. So, if we are this new online retailer, we're going to be operating at lower margins. So even if we do have, you know what I mean, uh, a higher revenue base, it's going to have to be materially higher when our margins are decreasing by freaking what 25% there. So it'll be interesting to see. And then they highlight the fourth quarter SG&A expense again, reduction. Once again, I think this is a load of crap. So we'll see when we do the model here in a minute. Same store sales, right, for the full year decreased 9.5%. And this is, to my point, excluding stores that were closed for 14 days or more. So stores that are counted in this in the full year decreased. Ones that were, when you look at it for just the fourth quarter, it was up 6.5%. So great. The new console launch gave us 6.5% boost to sales, but that's not going to sustain forever. So they got to do something. Overall sales decreased to $1.5 billion. E-commerce, it's growing, right? Under 91% of total sales or growth, and then 30% of total sales. So it's definitely growing, but Margins, once again, down 4.8% for the full year, just driven by the shift to digital or e-commerce sales. So that's all we have here in these slides, but we're going to go ahead and open up the model and walk through a little bit of this, and we'll make some assumptions here, and we'll see what kind of valuation we get at. So I've already pulled in the income statement, cash flow, and balance sheet, so we can build this out. If you're curious as to where you get this data, head on over to sec.gov. You're going to hit more search options, and then you can type in GME, their ticker, and then the 10K, and then the 10K. Then all of that will be available in here. They also have it on their investor relations page. If you usually just Google a company's name with IR or investor relations, it'll give you a link to it. So investor.gamestop.com. And at the bottom of these, if you read through the whole thing, they'll have financial statements as well. So, and real quick, we'll just look. So the stock price actually this morning, right, opened 20% down. So we're down to 146. So I think a lot of people are disappointed with how it shook out for the full year with the new console launch. But anyways, real quick, we'll look at the income statement. So I pulled data back to 2009 and then highlighted when new consoles launched. This was in the first video I have on evaluation to try to predict how Q4 would have finished and the full year would look for 2020. We can actually see from 2012 to 2013, right? Xbox One and PS4 launched. We didn't see a material change in sales. We actually saw a decrease. Same thing in 16 and 17. So I think in my last video, I was pretty convinced that a new console launch doesn't actually impact sales materially in a material amount. I think we see the same thing in 19 and 20 as well. So anyways, we'll pull this in, and right now everything's kind of loaded up and set. So all we really have to change here is we have to plug in our sales growth, our COGS, and our SG&A assumptions. And so for this, really for sales growth, I think a big part of this is, I think there's a shift to digital, and let me go ahead and, where's the management discussion? Here we go. There should be a revenue breakout. Yep, so 2020, 2019. So hardware and accessories, right? So yeah, their mix shifted to that from the new console launch. They're selling half now. Is that software decreased? I'm guessing, I don't know if software, if like the downloadable games, when you go buy a game and it has like a redemption code, I don't know if that counts in software. Probably does. And then collectibles, it's probably like the random little knickknacks and miscellaneous crap they sell. But you can see, right, like they don't break it out on here between shift to digital and regular. But while their digital sales are increasing, their store sales are decreasing. So, but I don't think they're completely taking over market share from the Best Buys, the Walmarts, the Targets, the Amazons, all the people that are already selling online. So I don't think we need to do anything too crazy to predict their revenue. To be honest, we see, so we could say, yeah, COVID hurt them this year. To quantify that is probably going to be difficult. But, new console launch, but it didn't, they still sold less in hardware and accessories this year than they did last year without a new console launch. And if we go back to 18, right, it's just been decreasing every year. All of it has. So my thought is maybe they, I'm going to give them credit in this first model we do. Or we're going to say they're just going to stabilize. They're going to, this year was their baseline. They have this new console launch, so they'll get a little bit of sales next year kind of from that as people are still buying the new console. On top of that, we're going to say without COVID, that'll kind of offset the decrease in other sales that they've been seeing. So we're going to give them credit. We're going to say, like, we're done dying as a business. We're going to be flat. And then from there, we're going to call them a mature company. And we're going to have them grow at, let's have them grow at mid single digits. I think that's like a fair assumption. And we'll see. I mean, this might be a really healthy assumption, right? But I mean, you can see from here what this has is by 2030, they're still not back to where they were in 2018. So basically, we're saying their business isn't going to die. They're going to stick around and just be this business that can operate in perpetuity. They found their spot. They're going to have a healthy mix of store sales and online sales and just kind of be a, a regular old retailer, nothing exciting. Now, here's the interesting part. COGS are actually going to get worse over time. So they've already said as they shift to digital, their COGS get worse. So, I mean, we can see, right, their digital sales went from being, I think it was 12% to 30%, and their margins got 5% worse. So if we're saying they're going to be half retail, half online or something, um, that's another 20% increase. I mean, their COGS is going to go up to 80%. So, I don't know how long that's going to take, but we're going to say it's going to take 5 years, and then we'll hold them flat at 80%. And then um, from there, you know, we can assume their e-commerce platform takes over from the brick and mortar, but they've gotten more efficient and better at everything. So we'll hold that stuff like that for now. And SG&A is a percentage of sales. So this is what I'm talking about, right? They're like, hey, look, guys, our SG&A went down $400 million. We're so great. Um, SG&A as a percent of sales is still 30%. You used to operate at 24%. So, I mean, the real story here is like you were a bloated organization in 2017, but you had the sales to have this larger organization. In 2018, sales started to dip. You didn't fire anyone. 2019, sales really dipped. You didn't fire anyone. 2020, you finally fired the people that just sat around and didn't doing anything, but you're still probably a bloated organization and have redundant people. So, you know, while they're saying, hey, we're so great, until I see that percentage of SG&A as a percentage of sales actually decrease, like you're you're not operating any more efficient. Like, yeah, you cut the fat finally, but the fat's been there for years. When you're operating at 23.8%, you probably could have been closer to 20% if you really had everything kind of figured out. And you can see, like, great, with these assumptions, they don't even cash flow positive in our model. So, I mean, it's they have a challenge ahead of them for sure, right? Like COGS, we already know as they shift to digital, COGS get worse. They've stated this multiple times in their press release. So it makes me question, let's see, where do they put it? Gross margin, decline of 610 basis points, lower margin console sales, freight and credit card fees with the shift to e-commerce, and broader promotional stance. Um, so, right, like maybe I'll be nice, right? We'll say, I mean, just to get them cash flow positive, otherwise you're not even gonna be able to get a valuation for this damn company. Yeah, I mean, this is tough. I still, I mean, as much as it pains retail investors to hear it, the short sellers might be right on this one. And you know, I guess we're going with an optimistic case because there's no way to probably have this company cash flow to give it an actual valuation, unless we assume they have operational improvement from all of these new hires that they've been making. Um, so, their new COO, she's going to come in. I just switched my mind. She's going to kick ass and she's going to change everything this company does. And they're going to start selling digitally profitably. SG&A, they're going to continue with this transformation and they're just going to keep firing people year after year until we get down to 23% back where they were. Um, so, I mean, I don't believe this valuation at this point. I think this just really highlights how much of a struggle um, in a fight for their life GameStop is in. This is probably why they were on the brink of bankruptcy not too long ago before this weird retail investor craze happened. But, even if I think we give them credit to transform their digital delivery service, and then they just start cutting SG&A like crazy, um, right? And we say 10% return, weighted average cost of capital. There's a lot of ways to think of this. Some people want to calculate the actual WACC of the company. I look at it this as an investor, what return do I require? And honestly, for a company like GameStop, I would probably want, 14%. It's risky, right? You're going to want 14 or 15% return on this. If you want a nice little 10% return, go buy some nice blue chip company that, grows 5 to 7% a year, right? You'll probably get that average 10% pre-inflation return. So I would say you need a higher cost capital to be comfortable with something like this. But we'll go with 12 just to be nice, I guess. Terminal growth rate, 3%. This is really just like, what are they going to grow at in perpetuity? If it's above inflation, then they're going to grow to be the biggest company in the world, which just isn't realistic. I usually do 3%. I think inflation average is 2 to 3% historically. Gives you terminal value, NPV that 3.3 billion. Enterprise value is the cash flows in the terminal value. Net debt, let's see, is that right? I think I might need to move that over to column E now. Yep. So this was from the old model before we had 2020 data. So let's move this over to column E. So 5.6, $5.6 billion value, and that's if this turnaround plan works. Yeah, I don't know. I'm not really buying it. And right now they trade at 10 billion, but this is just like because there's so much short interest because I think, they were trading back in October of 20. So after Ryan Cohen announced his takeover, 10, 15, 11, 15, 16, a little bit of run up, huge run up, drop back down to 40. Now they're at 141. So I mean, I don't know. I think it's going to be tough. We're saying $5.6 billion equity value in a super rosy scenario, right? And they're currently trading at 10. And I mean, I think, look, if we get rid of the super rosy scenario, right, we say, you're actually just going to hold these flat. See what happens here. Are they even positive? Slightly positive cash flow if we don't give them, but we have to give them improvement for SG&A. Otherwise, they're just never going to be positive. Then you get a $2 billion company. I mean, I still think you probably need a higher return, but that's fine. We'll leave it at 12. Okay, so you get a $2 billion value. Shares might be a little bit different now, but it's about a $27 share price. So if you really believe in the turnaround, sure, this company could be, I would say, a $2 to $6 billion company. If you really believe that all these things are going to happen, 2 to 6 billion is probably realistic, which is going to give you a valuation stock price between like 80 on the high end and 25 on the low end, so 25 to 80. And that's if you really believe that they're going to be able to do all this and just stop dying. But if sales continue to slip, right, I mean, they're done for. It'll be interesting to see how it plays out. But yeah, I hope you found this interesting or useful. If you have any questions or comments, feel free to leave them below. Yeah, thanks for tuning in.